Welcome to Yahoo Finance Live. I'm Shauna Smith along with Dave Brace. Let's get you up to speed on this afternoon's market action. A bit of a mixed picture when you take a look at the three major averages. The Dow, though, off just about 350 points. A lot of that drop has to do with the weak results that we got out of Goldman this morning. Goldman missing on both the top and bottom lines. We're seeing that reflected in Goldman stock today, and as a result, we're looking at the Dow off just about 343 points. S&P also in the red, off about 0.1%, but Nasdaq 100 holding on to gains just barely, though, up about 0.2%. Taking a look at the bond market, 10-year yield moving to the upside, up just 1 basis point, so not a huge move there, as the broader market activity today is rather muted. You're looking at the 10-year at just around 352. But let's take a look at where crude is this afternoon, because a jump up in crude now above $80 a barrel, up about 1.25% today, and Bitcoin still moving to the upside here. We talked about the resilience that we've seen in Bitcoin over the last several weeks on Friday, and continuing that march higher today above 21,000. Breaking down the sector action, a very mixed picture this afternoon. Technology, real estate among the leaders there. Communication services and materials lagging behind. XLF financials off just about 0.5%. Digging down into some of those bank stocks, I mentioned the miss from Goldman Sachs earlier today. That stock off just about 6%. But look at Morgan Stanley, the opposite there. Record revenue from its wealth division. That's pushing the stock up about 6%. And earnings are going to continue after the bell. We'll get results from United this afternoon. Ahead of those results, we're looking at United off just about 1%. We're also seeing some pressure from some of its largest competitors here today, with Delta off about 0.5%. Southwest also in the red, as well as American, Dave.
Interesting to see United down given the unprecedented demand. What do you make of that Bitcoin number? Ether's up 30% recently.
I don't know what to make of it. I think we're always trying to figure out why exactly it is moving. Certainly it did get a pop on that better than expected inflation print, or maybe improving inflation print, I should say, came in pretty much in line with what the street was expecting. But I think it was enough maybe to bring back some excitement here to Bitcoin. But it's really amazing given the collapse that we've seen in FTX, all of those headlines, and the fact that we're looking at Bitcoin above 21,000.
And still more rate hikes to come, which should be bad for Bitcoin and Ether, but not the case. Shauna, thank you. Let's get you up to speed now on some concerning data. Manufacturing activity in the New York area has slowed to its lowest level since the early days of COVID. The New York Fed's Empire State Manufacturing Survey tumbled 22 points in 1 month to negative 32.9. Now that's the lowest level since May of 2020 and lower than anything we've seen since pre-pandemic, with data going back to July 2001. This survey measures the percentage of companies expanding versus those companies that are contracting, and the expectation was -7, and again, it was -22, more than 3 times as bad as estimates. And Shauna, this is normally not a number we talk about here on Yahoo Finance because it is simply the New York area, but when it's this bad, unprecedented bad, it makes you think something in the foundation of this economy is also rotting beneath it and foretells what's around the corner.
Yeah, exactly. We know that there is certainly a lot of concern out there. We heard from a number of the bank CEOs last week warning that the next couple of quarters will likely be challenging. A number of them predicting a mild recession. We'll get to it in a minute, but James Gorman from Morgan Stanley was much more upbeat than some of his peers out there. But I think it also speaks to what we've been seeing in the recent surveys as well. PwC was out with a recent survey saying that 73% of CEOs believe that the global economic growth is going to decline over the next year. So when you take that and add in what we've just seen from this index here, certainly I think the safest bet is to say it's going to remain challenging. Things are going to be choppy, and that looming recession is what most people, most investors are the most worried about right now.
Gloomy outlook indeed. For more on the markets, we're joined by Invesco Investment Solutions Senior Portfolio Manager Alessio Delantis. Nice to see you, sir. So that setup that we just laid out, combined with that New York manufacturing number, do you share that gloomy outlook that is right around the corner, and the R word continuing to be reiterated by CEOs?
Thank you, Dave. Shauna, good afternoon. A pleasure to be here with you. We have been on the contraction camp for the whole second half of last year. But what we're seeing actually now is the data that you're discussing. We believe it's the impact of those long and variable lags with which monetary policy, the tightening of the Federal Reserve, is now showing up in the data. With that being said, though, an interesting dynamic has emerged in the last couple of months, which makes us a little bit more positive, more optimistic, especially for the first half of 2023. And the market pulse year to date seems to confirm that. We are seeing inflation come down more quickly than the deterioration in growth. And what that is leading to is to renew market sentiment, favorable market sentiment, where the market is looking at an outlook where the Federal Reserve may actually pause right here this quarter, or at least signal a pause to its tightening cycle very soon, and allow the economy to breathe a little bit. The unemployment rate remains near all-time lows. That is true here in the U.S. and abroad. So it's clear that we're not in a recession today. It's clear that we have some data challenges to face, but it's also true that the impulse on inflation is improving, and the market is looking at that with a positive tone.
So let's see, what does that mean then for the markets going forward? All three of the major averages in the green since the start of the year. How much higher then do you think we could potentially be headed?
So it's a good question with an interesting spin. We think that the better economic momentum, and therefore there are better odds for overall equity markets outside of the U.S. The China reopening trade, by the speed of the pandemic in China, is moving at such a rapid clip that it may be a full endemic phase by the end of February. So the market is already pricing in today a full reopening in around March or April. We're seeing the outperformance of emerging market equities over U.S. equities. We're seeing the outperformance of European equities over U.S. equities because the conflict, the weather-related fears around energy prices are subsiding, and the dollar is declining. So we expect single-digit positive expected returns for global equity markets, but with potentially a gap widening in favor of international equities over U.S. equities.
It's difficult to know how much credence to put into numbers that come out of China, in particular the GDP number of 3% growth. Difficult to believe much of that, but the population pulling back first time in 60 years, how significant is that in terms of their economy and their growth?
Well, those demographic concerns are really, really long-term concerns, that they are reflected in the potential GDP growth of the economy. To your point, China growing today with the cyclical downturn that we've seen at 3% is disappointing, but its trend growth rate, nobody expected to believe 8% or 10% as it used to be. We're now talking maybe about a 4 or 5% trend growth rate. So the cyclical rebound that we're seeing in the economy due to the reopening has the potential really to bring growth above its long-term trend over its perspective structural trend over the near term. And ultimately, for markets over a one-year time horizon, it's cyclical considerations that matter far more than the structural considerations such as demographic trends.
So let's say, what does that mean then for investors today? What should they be favoring when it comes to the value versus growth debate, when it comes to large caps versus small caps, when it comes to some of the cyclical sectors versus defensive? Where is the best place to park your money now?
Our picture is one that favors a cyclical rebound. So tilting equity portfolios towards regions, sectors, and styles that are more exposed to that cyclical rebound, that have more operating leverage. Emerging markets and European equities are more cyclical, more open to global trade than US equities. Going down the style boxes, as you were mentioning, we favor value over growth or value over quality, depending on how investors prefer looking at it, but that's our recommendation. And we position our portfolios down in caps. So we favor small and mid caps over large caps. And this translates to sectors that are more value-oriented. We favor financials, industrials, materials, energy at the expense of defensive sectors such as healthcare, utilities, and even technology. We believe technology has more defensive features with large profit margins and more of a quality bias.
We are through, and our last question here, we are through big bank earnings. Did you have one big picture takeaway, something you learned when you put them all together in one basket?
The earnings season should always be judged with respect to some of the idiosyncratic factors of the sector, but also knowing and reminding ourselves that earnings tell us something about what has just happened, not what is likely to happen. Earnings guidance continues to come down. I think from an earnings perspective, we expect overall flat earnings growth would be a positive outcome given how much we've been pricing in for a recession. And the sector, the financial sector, if we are right on our cyclical rebound call, should benefit from expectations of lower default rates and lower recession probabilities, at least for the first half of the year.
All right, Alessio DeLongis, great to have you. Thanks so much for joining us. Well, we are just getting started here on Yahoo Finance Live. Coming up, Morgan Stanley and Goldman Sachs both reporting big drops in investment banking revenue. We'll break down their quarterly reports. Then Apple refreshing some of its computer lineup. We have the details for you. And United Airlines reporting its fourth quarter earnings after the market closed this afternoon. We'll have the numbers for you as soon as they break. Don't go anywhere. Take a look at Goldman Sachs. Look at that, losses of just about 6%. Shares sliding into the close. The stock on pace for its worst intraday performance in nearly a year. This comes following its fourth quarter earnings report. Now, the bank missed on both the top and bottom lines. Quarterly profit dropping nearly 66% from a year ago. EPS of $3.32. That fell short of what the street was looking for, and it was actually the bank's biggest earnings miss in more than a decade. And Dave, when we take a look at these numbers, I think the street expected these results to be weak, but they were far worse than they had been expecting. Goldman also setting aside $1 billion to cover potential future loan losses. I think it speaks to the environment that we are in right now and really echoes what we heard from David Solomon, the CEO there, saying that CEOs are cautious, particularly for the near term, mentioning the next couple quarters will likely be a bit bumpy and a bit challenging.
Yeah, I think if there are two patterns that emerge throughout all the bank earnings, it's future loan losses, and to your point about $1 billion, and the other one is investment banking just wiped out, nearly devastated. Basically, all the big banks reporting about a 50% decline in mergers and M&A activity. So those are the two giant takeaways. We'll get to Morgan Stanley in a minute, who has an interesting upside. But first, Octavio Morenzi basically surmised Goldman well from Optimus. More miserable report than expected. Operating expenses up 11%. To your point, when you've got profits down nearly 70%, what does that tell you is around the corner? Probably even more layoffs than the 3,000 that Goldman Sachs has already had to endure. And on one hand, you have to figure investment banking is going to turn around in 2023. But on the other hand, does Goldman find themselves, do they insulate themselves from the macro situation better than they did last year? You have to figure David Solomon's goal is just that. They have suffered big losses in the consumer area of banking and largely exiting that. A brutal, brutal report for Goldman, and nothing like we've come to expect.
Yeah, certainly not. And I think this just speaks to the environment that we are in right now. And the comments that we got from Solomon, like you said, really were similar to what we heard from a number of the bank CEOs last week, just in terms of what they were forecasting, in terms of their guidance. That was a huge mover for the stocks on Friday. And I think that's the same here when we're looking at Goldman off just about 6%, the worst performer in the Dow, and a big reason why we're off just about 300 points. I also want to take a look at Morgan Stanley, because Dave, you mentioned it there, and the numbers really do tell a different story, because the bank beat estimates on both the top and the bottom line. Revenue coming in at $12.75 billion, down nearly $2 billion from a year ago, above the Wall Street expectations. Their wealth management division, that's what standing out to me, just in terms of the rising rate environment that really boosted net interest income for the quarter there for Morgan Stanley, offset the drop that we saw in deal making. You mentioned the massive drop that we see in M&A across the board. And CEO James Gorman, he was relatively upbeat, especially when you compare it to what we've heard from many of his peers.
Oh, I thought it was astounding. When I read the words from their CEO, it almost like felt the sun came out, because we've heard nothing but mild recession predictions from every big bank CEO. And here it is from Gorman. We're not of the view that we're heading into a dark period. Whatever negativity in the world is out there, that's not our house view. So we want to make sure we're positioned for growth. He even talked about, again, M&A activity picking up in 2023, because theirs was down 48, 49%, just the same as Goldman was. Sure was nice to hear some optimism from a big bank CEO, because they have such great visibility to the consumer. But wealth management being the key difference between Morgan Stanley, one of the biggest gainers on the S&P, and Goldman Sachs, one of the biggest losers on the day on the S&P.
Certainly, UBS was out with a note saying that the fourth quarter results from Morgan Stanley, they were encouraging. And I think that's important to point out, especially when you take a look at some of these other numbers within that report. You mentioned the drop that we've seen in investment banking across the sector. Revenue from investment banking for Morgan Stanley was off nearly 50%. Investment management arm revenue there down 17% to $1.46 billion, but still, of its major competitors out there, Morgan Stanley definitely winning the prize here for most upbeat outlook heading into the rest of the year.
Yeah, they were definitely positioned well given the macro setup. All right, earlier today, Apple debuted new versions of its MacBook Pro and Mac Mini computers. Yahoo Finance's Dan Howley joining us with the latest there. Dan, what are we learning?
Yeah, that's right. We have two new laptops and desktops, as well as two new overall chips. So let's go over the chips first, since they're the underpinnings to these new pieces of hardware. We have the M2 Pro and the M2 Max. Now, you'll remember when Apple first announced its M1, it also debuted the M1 Pro and M1 Max a few months later. The Max is really supposed to be the top-of-the-line chip that Apple has to offer. It's what they want to be kind of their halo product. They talk about how it's incredibly powerful. In fact, in this particular instance, they say it's one of the most powerful, if not the most powerful, laptop chip available. So we have the M2 Pro and the M2 Max. Now we have those are going into the new Mac Mini and MacBook Pro. So there's two versions of the MacBook Pro, 14-inch and 16-inch. If you want that high-end Mac M2 Max, you're going to have to get a 16-inch or the high-end 14-inch, and then the Mac Mini comes with the M2 and M2 Pro. So really all of this is just showing how Apple is bringing all of, at least trying to bring more, if not all, of the design of its important components in-house. And that does a number of things. It allows it to change the design of the actual hardware, so however it wants its products to look. It also allows it to benefit from things like its own capabilities. For instance, it says that the Mac, the 16-inch Mac with an M2 Pro lasts 22 hours on a charge. That's not something you would be able to get out of an Intel-based product in the past. So it's really kind of pushing these ideas forward. And oh, by the way, it eliminates one additional wrinkle in its supply chain by designing these components. Doesn't have to lean on someone like Samsung or, in the case of the upcoming display that's been reported, or as we said in the past, Intel. And then it also ensures that when it comes to these products themselves, it has full control over how they're rolled out.
Certainly will be interesting to see what demand looks like for these new products. Dan, let's also talk about Microsoft, because there's a new report out from Sky News saying that the tech giant is preparing to lay off thousands. What do we know at this point?
Yeah, so far, according to this report, this is from going to be some recruiters on the side of the business. It's not necessarily anything that we're hearing as far as engineers or anything along those lines. So this is still, kind of what exactly we'll get is very unknown. They previously laid off about 1,000 workers earlier in the year, and this just goes to the broader idea that big tech is facing this harder time of layoffs. We had obviously Meta, Salesforce, more companies than that, Redfin, a litany of firms, and it seemingly is really part of the big tech conversation, but there are still plenty of other tech companies that aren't facing these kinds of issues. So while it's harder to understand that when it's not as spoken of as often, it isn't necessarily a huge issue for all of tech.
Well, with the predictions of an unemployment rate of 5% at the year end, we're looking at a lot more layoffs ahead still at 3.5%. Really low. Dan Halley, Yahoo Finance Tech Editor. Good to see you, man. Coming up, from Hellman's Mayo to beauty brand Dove, Unilever, as some of the best known brands in this country. We go to Davos for a conversation with the company's CEO to get his take on the consumer. That's next. World Economic Forum kicks off today for its first in-person meeting after a 2-year hiatus. World leaders, business titans, and politicians alike all gathering at the event. Yahoo Finance's editor-at-large Brian Stassi sat down with Unilever CEO Alan Jope to discuss climate change, the outlook for consumer staples, and inflation.
Joining me now is Unilever CEO Alan Jope. Alan, good to see you in person. Another CEO I talked to, but no jacket. Aren't you guys cold?
Oh, come on, it's great.
I know, I got to tough it up here. But what brings you here to the World Economic Forum? How many WEFs have you been to, and what are you hoping to get out of this?
Yeah, I think, first of all, it's a good place to listen and learn and build your world view. Secondly, it's super efficient for us to meet our partners, lots of our business partners, partners from civil society, some governments. It's a highly efficient use of time in that regard. And we do have an agenda that we're driving. So Hanneke Faber, our president of food, she's here driving an agenda on regenerative agriculture so that the food system becomes a bit more sustainable and we de-risk the food system. Our CFO, Graham Pitkethly, he's here driving standardization of non-financial reporting because there's a great danger that that proliferates and becomes unmanageable. I'm driving things like plastic and recycling. And so we come to listen, meet with partners, and drive a few points on the Unilever agenda.
Unilever has always struck me as a company driven by purpose, lots of focus on climate and doing things differently. Why is that so important within your company, but also with consumers?
Well, first of all, it goes back to our very founder's DNA. Back in the 1870s, William Lever was talking about making cleanliness commonplace and lessening the load for women. So he was an early public servant on health and women's rights, and it's stayed with us. But let me be clear, we're not an NGO, we're a commercial organization, and this is all done around creating value for our shareholders. That's the ultimate goal. The business case is pretty clear. Consumers are choosing sustainable brands at a preferred rate. We believe the investments take out costs, they don't add costs to the business. It definitely lowers risk, and most of all, doing business on a sustainable platform is a magnet for young talent. So those are the reasons why we get into it, but it's very commercially driven.
What do you say to investors who say, I just want Unilever focused on making products? Why do they have to stand for something? How do you deal with that pushback?
Well, first of all, the majority of investors don't take that view. So BlackRock want to engage with us to understand how do you follow a carbon reduction agenda. Aviva want to understand how do you improve the nutritional standard of your foods. Legal & General are working with us on making sure that fair living wages are paid in the value chain. So the overall sentiment of investors is one of strong support for putting sustainability at the center of the business. Anyone who's more skeptical, I think there's only one answer. We have to show that it drives superior financial returns. We're not an NGO. We're a commercial organization, and so everything's driven by a business case.
The mood here at Davos is a little gloomier than I thought. I think it was a PwC survey said 73% of CEOs expect the world to be in a recession this year. Do you share that view?
Well, the world's not flat.
Wait, it's not?
So we are very bullish on South Asia. So not just India, by the way, Pakistan, India, Bangladesh, all doing very well. Southeast Asia, Vietnam, Indonesia, the Philippines, Thailand starting to come back strongly. We see extraordinary ability to navigate uncertainty in Africa and Latin America. So far, the US consumers held up well. Europe is a more difficult space. So I think there will be parts of the world that go into recession this year. But we will choose to ignore that in the parts of the world that are enjoying continued growth. And South Asia, Southeast Asia at the heart of that.
A part of the pressure on consumers is they're dealing with price increases from a lot of consumer products companies. Do you plan to raise prices this year, and where in the portfolio?
Yeah, so raising prices is the last thing that we want to do when our input costs go up. We first look at efficiencies. Actually, we've asked our shareholders to take some of the pain. Our margins will go down in 2022. That's what we've guided. But ultimately, we have needed to pass along price. I would say right now we're probably at peak inflation, but not peak pricing. So yes, there is more cost coming through in our supply chain, and there will be more pricing that comes through.
Are consumers trading down?
They're not. Nielsen take a look at our business, certainly in the Unilever portfolio. 35% of our portfolio is premium at a 120 index or above to the market, 50% in the middle of the market, and 15% in our value offerings. and the fastest growing segment of that is the premium portfolio. So I'm sure there's down trading happening in some places. It's not a material part of what we're seeing in our business, although we are constantly making sure that in our portfolio we have value offerings where that's to start to emerge.
Last time I talked to you, maybe 2.5, 3 months ago, you seem to have braced your new activist investor and board member, Nelson Peltz. Said he's doing, and he has good ideas to help turn this company around, drive better results. Now, since then, Nelson has taken a campaign against Disney, and they do not have that view or that same approach. As someone that has dealt with Nelson, why are you embracing him, and a company like that may not?
Nelson Peltz has joined our board and brought all kinds of good ideas. His view on what the company needs to do is very aligned with the agenda that we're working on. A big part of our agenda last year was to simplify our organization. That was something he felt needed to happen. Somebody who has got a strong track record in the CPG industry, we thought would make a good board member for Unilever. I can't obviously comment on other companies.
Does he unlock value in those meetings? What's his thought processes?
I shouldn't comment too much on one particular board member, but we expect all of our board members to make contributions that help guide the company and steer us in the right direction. Nelson's an experienced board member who is very focused on performance and on setting up the company for the future.
You're also fresh off a key investor day too. Really interesting slide deck. It does seem like you are driving a reimagination of Unilever. Where are you at in that process?
So over the last 5 years, we've really been working on 4 things. First, making sure our executional muscle is in good shape. Secondly, continuing to evolve the portfolio, exiting spreads, exiting tea, building up a business in luxury beauty and health and well-being has been an important part of our growth agenda. Third is to make sure everyone understands our strategic choices. What markets matter? What categories do we care about? What channels are we building in? And then the fourth part of reinventing Unilever has been this very substantial organization change from a complex matrix to 5 business groups with full accountability and extreme simplicity. So I only have now 5, I can either say throats to choke or backs to pat.
Before I let you go, you're supposed to be retiring at some point this year. What's next for you?
Well, at the moment, I'm 100% focused on Unilever, making sure we keep cranking out quarter after quarter. That's my job. I have very, very many interests outside my business work, and it'll create some time to follow.
Some travel?
There'll be a bit of travel. I'll get the chance to finish our round-the-world motorcycle trip for a start. That's work in progress.
Oh, geez. Well, stay safe and wear a jacket too. Unilever CEO Alan Job, good to see you again.
Thank you.
Enjoy the rest of Davos.
You bet. Cheers.
Terrific color there at the close. Good stuff from Saz. Coming up, shares of liquor giant Diageo moving higher after it announced it was making a purchase worth nearly $500 million. We'll tell you who they're buying next.
It's time for a triple play. 3 stocks that we're watching in the final 30 minutes of trading. We have Robinhood, Tesla, and Diageo. Let's start with Robinhood on its push here further into the media business. Now, the retail trading platform launching an independent brand called Sherwood. Now, it's a move that builds on the firm's popular daily markets newsletter, Snacks. Sherwood Media will be a subsidiary of Robinhood and led by Joshua Topolsky, who co-founded The Verge and was also the co-creator of Vox Media. Now, in a blog post, Robinhood writing that Sherwood will be, quote, a home for news and information about the markets, economics, business, technology, and the culture of money. It will be interesting to see how all of this plays out. But Robinhood expanding its business, looking for, another revenue stream. We'll see. We know that its markets newsletter has been very successful so far. So maybe this push, I think you could argue, makes a lot of sense.
Yeah, I'm a little surprised they're investing in this content, but I guess get more retail traders in there, get more people that are interested in those big tech names that Josh Topolsky, former Engadget guy, so company man here, former back in the past, so maybe you can focus on those big names like Apple and Google and all those guys, get people excited about that, and of course all those meme stocks, so I think that's a Sherwood Media, interesting name for Robinhood, right? So speaking of big tech, I'm watching shares of Tesla today. Goldman analyst Mark Delaney weighing in on those big price cuts to the Model Y and Model 3. On the one hand, Delaney sees the price cuts as implying weaker demand. On the other hand, he sees that's a big move to boost volumes. And as the company ramps up its kind of factory supply lines and chains there, it can decrease costs due to economies of scale. Now, these are moves competitors can't match just quite yet. Delaney maintained his buy rating on the stock, but cut his price target to 200 from 205, noting a slight hit to EPS and average selling price, but still pretty positive on what they did last week.
Yeah, and if you believe the reports, again, these cuts we're talking $13,000, which I think the real boost is allowing that $7,500 tax cut on top of it. But the online outlet Electric is reporting record demand and record sales for 1 week in North American sales. So I think that note is largely right. Lowering demand, but a tremendous success in terms of the short-term benefit, a huge boost for Tesla. My play is Diageo, the global liquor giant, making another major purchase, buying Don Papa rum on a deal worth up to $473 million. Eye-popping cash. Diageo owns Johnny Walker, Tanqueray Gin, Smirnoff Vodka, Don Julio Tequila, more than 200 brands and 180 countries in all. They say Don Papa is the, quote, super premium plus category, and that rum overall saw a compound annual growth rate of 27% between 2016 and 2021, and that Don Papa even topped that. Analysts at Citi call the rum category the next exciting growth area. One industry analysis projects global drink markets total to reach $300 billion in 2023. $300 billion. Diageo outperformed the broader market last year. It's up 6% this year. And you can see about almost 2.5% on the day. Just want to know, are you bullish? Are you bearish on rum? We'll get to Diageo in a minute, but are you a rum drinker? Do you think there's a growth opportunity here in the U.S.?
I don't often drink rum. I did recently go to Bermuda and had the Swizzle, which is one of the country's signature drinks. It has rum in it. So I came back a huge fan of rum.
Oh, yeah.
Do I drink it that often, though? No, but I think it's very, very hard to argue with those numbers that you were just going through in terms of the growth that we have seen over the last 5 years, what that growth could potentially look like over the next 5 years. It makes a heck of a lot of sense why Diageo is pushing further into this business.
It's funny going from we had the brown liquors, the whiskeys and the bourbons doing well, pivoting into the gins, then tequila, and I thought we were still in tequila, but I guess now we're going into rum too. So I'm just going where the ball's at, right?
Largely speaking, it is still tequila time in terms of the growth numbers are much bigger. But I think you make the point. Everyone travels abroad right now, has rum. It hasn't translated back here quite yet, but I think that's what they're betting on. You love going to an island and sipping on a rum.
If someone here can make a mean swizzle, I will certainly be ordering that very soon.
Swizzle. I gotta try that.
It's good. A little bit of pineapple juice, orange juice, and you figure out the other ingredients. Maybe I should just make it in my house, but it's very, very good. All right, coming up next, lots of headlines out of China, including a dismal economic report and its first loss in population in more than 60 years. We've got the latest for you when we come back.
Turning now to news out of China, the country's National Bureau of Statistics recording a drop of about 850,000 people in population. Why is that so significant? It's the country's first recorded decrease since the early 1960s. The move could make India the world's most populous nation and comes as the Chinese government is under real pressure to grow its economy through consumption rather than through production and exports. And look, a lot was made of the GDP number. This is far more significant when you consider China's economy, plus the fact that we don't know how much to believe that actual 3% GDP number. This has huge ramifications down the line. And I think all the data you're getting out of China, or that Xi Jinping gets out of China, tells you why they are reversing their zero COVID policy. There was real panic.
Yeah, they need to do something to stimulate their economy over there. Clearly, we have seen a significant slowdown in China. When you take into account that this is the second slowest growth rate on record, really speaks to the severity of the situation over there. But I also think it's important to point out what it means for U.S. investors and what it means for a lot of U.S. companies. Take an example, Apple. There's a story in the FT recently talking about the exposure to China. Even though Apple has started to diversify its supply chain, it's still very reliant on China, making more than 80% of its iPhone, its Mac, its iPads, its AirPods still manufactured within the country. And Apple, far from the only company here that could feel the impact continually over the next coming years of that population drop and also the slowing growth over there. Nike, for example, Starbucks, Coca-Cola, just some of the bigger names that rely heavily on sales in China. So if you combine the weaker economic picture there, what that could mean going forward certainly could mean some pain here for U.S. investors if, in fact, you are invested with some of those names.
And if you look at some of the investments today, Baidu, JD.com, Pinduoduo, three of the biggest four losers on the Nasdaq today, despite all the optimism we're hearing out of the China reopening. So it really makes you wonder how significant that reopening is. And as for that population, it's only going to get worse. Most predict it will continue through 2030. And we just reported 60,000 COVID deaths since their reopening, only going to facilitate with the Chinese Lunar New Year. Some believe that will be the biggest super spreader event we've ever seen.
Yeah, it'll be interesting to see what numbers actually do come out of China in the coming months. All right, well, we want to stick with China. Look at it from an investment perspective, what a declining population and slowing economic growth means for investors. And for that, we want to bring in Alejo Cherwanko. He's the Chief Investment Officer of Emerging Markets Americas at UBS Global Wealth Management. Alejo, it's great to see you here. So what does this mean, I guess, from an investor perspective? How should we be looking at these headlines?
Absolutely. Thank you for having me. You made really good points about what's going on in China, starting with the GDP number that came out quite recently. Look, I think this is purely backward-looking data. This does not contemplate the economic impact of the reopening, which is very significant. The same way that China engineered a contraction in a way in 2022, it's engineering a recovery in 2023. And on the back of this information, I think the rally in Chinese equities that we've seen in recent weeks has further room to run. The reopening in China is boosting GDP, but it's also boosting earnings, not only within China, but also globally to some extent. We shouldn't forget that China is the largest importer of commodities among other goods. And China is also a big consumer of tourism. As of 2019, 150 million Chinese folks went out of China for tourism purposes, spending close to $250 billion per year. This is going to be a boost for the economies that are exposed to Chinese tourism. On the other hand, you rightly highlighted secular drags on Chinese growth, population contraction. This is not new. This is something that will without a doubt be a headwind to economic expansion for many years to come. So we got to balance the cyclical with the structural in a way.
In terms of China's goal of becoming the world's #1 economy, how significant is their first population contraction since the early 60s?
I think it is significant because when you look at, what GDP growth is made out of, you're talking about the growth of your human capital, the growth of your physical capital, and the way you combine these two. How productive are you in putting together human capital and physical capital? As you rightly pointed out, the growth outlook for human capital is constrained, right? At least the number of people. You can invest in the quality of education, the quality of healthcare to try to boost this up, but it's not going to be easy. Therefore, you got to rely on physical capital, investments in this area, and of course, productivity. I would argue that China has quite some leeway so as to improve both physical capital and particularly productivity. So the story of convergence and the possibility of China becoming the number one economy in the world is not completely out of the possibility. Is of course a lot more challenging that we thought just a few years back.
And Alejo, looking within China, what do you like? What are some of the best ways to play it?
Look, I think you should not only contemplate investing in H shares, but also include some A share exposure in portfolios. I'm talking about shares that trade in Hong Kong offshore, as well as in Shanghai and Shenzhen domestically. But the story of the China reopening shouldn't end exclusively within the frontiers of China. As I highlighted earlier, big spend in commodity, big spend in tourism. This should boost economies in Southeast Asia. This should boost economies in Latin America. So I think the opportunities in international markets are going to be fairly attractive as we look into the remainder of 2023.
I want to get your thoughts quickly on one of the biggest situations around the planet, which is the insurrection, riot, whatever you want to call it, in Brazil and their political instability. How does that weigh on the economy and investments?
Look, it's undoubtedly an unfortunate set of events that took place on Sunday, January 8th in Brazil. Of course, a lot of parallels to what had happened in the US on January 6th. Quite a number of differences as well. We need to remember that Brazil already had a new sitting president. We need to remember that a broad range of media stakeholders, political stakeholders spoke very, very much against this event. So I think we're moving past this headlines, and investors are focusing on economic policy making under sitting President Lula da Silva. The news out of Brazil is not great in terms of the proposals for how to manage fiscal accounts, the proposals on how to manage quasi-sovereign firms in the country. At the same time, in our analysis, Brazilian assets are fairly cheap, equities, bonds, to some extent the currency. So you got to be selective. There are some opportunities in Brazil, in a region that is going to be characterized by a fair amount of political risk. But to be frank, where in the world are we not seeing political risk these days?
That is an excellent point. Unfortunately, it may have started here. Alejo Cherwanko, Chief Investment Officer, Emerging Markets Americas at UBS Global Wealth Management. Appreciate it, sir. Coming up, a rocky ride for Pfizer, why one analyst sees major headwinds ahead for the pharma company. That's next. Wells Fargo slamming Pfizer with the downgrade from overweight to equal weight of the company's post-COVID future. You can see shares falling up more than 3%. The analyst behind the call seeing Pfizer's efforts as underappreciated by investors, but still believes it needs a reset. Here with more is Yahoo Finance's Anjali Kamlani. Anj, what's the latest?
That's right, Dave. Well, as you know, you mentioned the Wells Fargo downgrade, so let's get that full quote up for you. It is, quote, "We think Pfizer needs a COVID reset before the stock could work again. We think the company could have an attractive profile as it aspires to grow pretty significantly in the next coming years." Now, really what's on tap for Pfizer is they are faced with, of course, a rock-solid blockbuster with the vaccine and Paxlovid as well. And moving on from that, as we know, the company needs to move on from COVID. And what does that pipeline look like? They do have some patent cliffs that they're looking at for some of their older blockbusters, but the company has been looking at this for some time. In fact, earlier in May of 2021, CEO Albert Bourla told me, quote, "We do think our stock is undervalued, but we do not worry that investors cannot see it." So at the time, he was convinced that the company wasn't getting enough credit for its COVID products, but that it could soon. And they've done a lot of stuff in terms of M&A, looking at new products, getting in from the outside. And that's really where the company's focus is. But I want to show you a really interesting chart, which is the operational growth of the company per quarter. This is quarter one of 20 versus, quarter four of 20 versus growth without the vaccine. And if you take a look at what 21 looks like, that's an even more astounding number, 106% with COVID products, -2 without, and that's the revenue there. So really interesting focus for the company, but Albert Bourla did tell us that he knows that this is the year that they're going to be releasing about 10 products, he hopes, and he spoke last All Market Summit with Julie Hyman, and here's what he said.
It is the year that we can prove to the world and we can prove to us that we can do multiple launches.
So as you can see, company is ready to prove itself. They've been trying to erase this idea that they're a COVID-only company. We'll see how it goes.
Yeah, they were around pretty successful prior to COVID. It is a reset year, though, a proving time. Anj, thank you so much. All right, coming up, we're counting down to the closing bell on Wall Street. Stay with us here on Yahoo Finance Live. All right, the Dow's sinking as we get towards the closing bell. Let's bring in Yahoo Finance's Jared Blickery to break down the market action. Welcome back from vacation, sir.
Appreciate that. And let's talk about the Dow because we were about to snap a 4-day winning streak right here. You can see the Dow's off more than 1% at session lows. We're just taking a look at that right now. Nasdaq still holding on to some green. That would be the 7th. I believe it's the 7th straight day of gains. Of course, I wasn't here for most of those. Now, here's the sector action for today. Tech in the forefront, materials in the backseat, along with communication services. But I want to focus on crypto here. So just give me a few minutes for that. Here is Bitcoin. Looks like it's doing a whole lot of nothing, but guess what? It has climbed to over 21,000. That is a price we haven't seen in about 4 months. Let me just show you a 10-year chart. Now here is the previous high, and it's hard to see here because it spiked up on an intraday, maybe intra-week basis here. But in late 2017, we had that 20,000 high. That's why it is so important to stay above 20,000 right now. Let's take a look at some of the crypto stocks that are bumping today. And one of the ones that caught my attention is Silvergate. Now, it's only up about 64 basis points. Check out the performance over the last year. Now, it, along with many other firms, suffered tremendously with the fallout from FTX. It just reported earnings this morning, and in the fourth quarter, it lost about half of its assets. You can see over the last year, down about 90%. So it hasn't been favorable to Silvergate. Is the worst over? We don't know yet, but here are some of the other crypto stocks that are bumping today. BT, that's up 17%. That's Bit Digital. That's another one that's been hammered here. Nice to see some of these markets coming back. And let me just show you what's been happening with our leaders this year. Now, this is focuses on leaders and sentiment. Baito is a crypto ETF. That's a Bitcoin ETF. That's up 30%. Then we got ARK, meme stocks, Chinese stocks, solar, all of those outperforming. So that creates an interesting situation where we got some fringe markets absorbing capital. Let me just go back to an intraday view, and we can see that a lot of these meme stocks are jumping today. GameStop up, 6%, CoinDesk up 8%. So is this the new norm? Are we going to go up in 2023? I'm going to send it back to you guys. We got a few seconds here for another discussion.
Yeah, Jared, it's interesting here just to try to make sense of the action that we've seen in the meme stocks. A lot of that, at least over the past week, has been tied to Bed Bath & Beyond. After the company warned earlier this month that it was going to have to file for bankruptcy, yet it has not announced bankruptcy. They came out with terrible earnings, yet we saw retail traders pile in. So I don't know how much we're going to see this momentum or how much we could really, I guess, depend on this momentum sticking, given the fact that it's so hard to wrap your head around why exactly we're even seeing the gains that we have seen so far.
Few 10 seconds worth of comments here. That's what we got. Meme stocks have surged many times in the last year, and guess what? They tended to coincide with peaks in the general market. So if they did extend this time, it would be an aberration. Here's the closing bell.
All right, well, that closes today's trading day. Again, we're looking at a mixed picture. All three of the major averages are mixed. The Dow and S&P ending in negative territory. You can see the Dow off 391 points, right around the lows of the day. S&P off about 0.2%. The Nasdaq, though, hanging on to gains. In terms of the sector action, biggest decliners, materials, XLB off nearly 1%. We're also looking at losses from communication services and industrials, the worst performers of the day. In terms of where we did see some gains, consumer discretionary, consumer staples, energy, technology, really just holding on to some of those gains. All right, let's talk about some of the biggest movers, the biggest stock stories of the day. First, we got to take note of the moves that we saw in Goldman Sachs and also what we saw in Morgan Stanley. I mentioned the fact that the Dow was off 391 points. A lot of that had to do with underperformance that we saw in Goldman, with that stock closing off about 6.5%. The drop there coming after the company missed on earnings on both the top and bottom lines, posted a profit drop of just about 70%. And comparing that with what we heard from Morgan Stanley numbers were actually relatively strong, especially when you're comparing it to what we saw more broadly speaking across that sector. But Morgan Stanley beating on both the top and bottom line. Record wealth management revenue, that sent shares up nearly 6% today. They also posted some growth at their trading business. CEO James Gorman saying that he is more confident that deal making is going to come back around once the Fed does in fact pause its rate hikes. And that's a big contributing factor to some of the gains that we're seeing in Morgan Stanley today.
Yeah, really the only optimistic tone we heard from a big bank CEO, and largely because wealth management. Again, they, like everybody else, struggle with investment banking, which is essentially down about 50% for all the big banks, which drove Goldman Sachs to that disastrous report. Profits down about 70%. So yeah, Morgan Stanley really dragging the Dow down, up, and Goldman Sachs driving it right back down. What's the real theme? Investment banking is going to struggle. Set aside $1 billion, and everybody set aside hundreds of millions, if not more, for future loan losses. Really the two themes that have emerged, with everyone predicting a mild recession ahead, is really the bank's story.
Yeah, certainly it is. And I think you have to really just it begs the question as to how bad it's going to get. And if you compare some of the commentary, at least for Jamie Dimon now saying we're expecting a mild recession, that's a huge step down from the hurricane that he had predicted just about a year ago. So maybe things aren't going to be as bad as some investors have been bracing for, but I think we can really bet on a slower growth environment going forward.
Jamie Dimon's never going to outrun the hurricane, is he?
I don't know.
You think 10 years from now we're still talking about the hurricane?
I hope not. I hope something else happens between now and then.
He's accomplished an awful lot, but that is every time.
And he walked it back, to be fair. He did kind of walk it back, put it more in context, but really that hurricane headline grabbed a lot of headlines. It's a tombstone headline. All right, let's talk about Alibaba. Shares falling on the first day of trading since famed meme stock leader Ryan Cohen bought shares in the Chinese e-commerce giant. Baba shares sinking as a slew of warning signs come out of China, including declining population and shrinking GDP growth. It is interesting when you look at some of the big losers on the Nasdaq on the day: Baidu, JD.com, Pinduoduo, three of the biggest four losers on the Nasdaq. But back to Ryan Cohen and his move here with Alibaba. Look, likely to be unsuccessful. This is not a meme stock. This is not anything like Bed Bath & Beyond or GameStop, for the obvious reason that you're dealing with the Chinese government here. You're not just talking about investors. You're not talking about our markets. You're talking about one thing you cannot control is the Chinese government, who is obviously a stakeholder and has really clamped down on the Chinese tech sector. Even if that's loosening, they ultimately have the word here, the last word. And I don't think Ryan Cohen is likely to overcome that. No, I don't think he's going to have the outsized impact that he has had on some of the other companies. And also, not to mention, Alibaba is a stock that is a $300 billion market cap. So just given the sheer size of it, you have to question about how much outsized impact he's going to have. It does seem to be that he will be pushing for more buybacks from Alibaba. But of course, we will see how all this plays out.
Does he just want more retail traders to get involved with the stock? Is that ultimately the goal? He knows what he cannot accomplish here. He knows how small that is in terms of their overall market cap.
Yeah, and it seems to be, at least taking a look at the reaction from the streets so far, he could get more overseas investors interested in Alibaba again, which in fact, if he does do that, that of course would be a positive here for the stock. He is a high profile investor. We know he does have a very core following here, so it could add some positive sentiment here to Alibaba, which has been down pretty substantially over the last 2 years. All right, let's get to a big winner here, and that is Roblox. The stock closing up nearly 12%, leading the Nasdaq higher. The driver, a solid bookings update here from the company Roblox, estimating that bookings of up to $450 million for December. That beat the street's expectations. It's important to point out that shares have actually been down over 50% in the past year, and this company is going to stop reporting its monthly numbers this spring. But given the outsized impact that these numbers are having on the stock today, certainly worth it to mention it. Daily active users in December jumping 18% year over year to 61.5 million. Hours engaged, Dave, almost 5 billion. Impressive numbers here from Roblox, and we're seeing that reflected in the stock move today.
Yeah, look, it is a solid number to come out. Can you bet on this long term? It doesn't fit any of the patterns that we've seen in gaming. It doesn't look sustainable when you look at the overall market. It looks like largely something we saw in the short term, but you got to look at a company that was at what, $80 in December 21. So it's all the positive was really taken out of it. Now there's some upside. I don't believe this is sustainable. We shall see. All right, another stock we have been watching is Disney. Shares closing, if we could put those up, there we go, after the break, as the company came out swinging to defend CEO Bob Iger against activist investor Nelson Peltz, who, as you know, is lobbying for a seat on Disney's board. Disney saying In a shareholder presentation, quote, Nelson Peltz does not understand Disney's business and lacks the skills and experience to assist the board in delivering shareholder value in a rapidly shifting media ecosystem. Yahoo Finance's Ali Canal here. That is a mouthful there.
Yes.
Mixing just very clear their intentions. Thanks, but no thanks, Nelson.
Exactly, and Disney has really taken on this position since this proxy fight escalated last week. Disney really doubling down that the current Disney board is the right board for shareholders. That's a direct quote from that updated proxy statement that we received this morning. Peltz, of course, he's been an ongoing critic of Disney, Bob Iger, and also Iger's famous acquisitions. He recently slammed the company's $71 billion purchase of 20th Century Fox, telling CNBC, quote, Fox hurt this company. Fox took the dividend away. Fox turned what was once a pristine balance sheet into a mess. Disney, though, as you mentioned, has fully defended those decisions, saying that those Iger-era deals, which also included Marvel and Lucasfilms, were transformative for this business, made the business the media powerhouse that it is today. So Disney doesn't really seem to want to entertain anything Peltz has to say here. But Peltz's Trian Fund does own about 9.4 million shares of Disney stock. That equates to roughly 900 million. Trian has said that the bulk of Disney's problems are self-inflicted. They are pushing for more cost cuts, operational adjustments, and then, of course, a post-Iger successor, which is something that Disney wants as well. But if you just take a look at the stock price, I mean, in 2022, shares fell about 45%, the worst annual stock performance for the company since 1974. And Iger, on top of all this drama with Peltz, is going to have a lot to deal with streaming profitability, very iffy right now, the future of Hulu, ESPN, etc. So a lot that Iger has on his plate.
Yeah, certainly a lot on his plate. Ali, real quick, let's get to WWE. I know you've been tracking this story. You've been talking about potential buyers there for the business. The stock actually got an upgrade from Wells Fargo. What do they like ahead of that?
Yeah, WWE is one of those stocks that's really been in the spotlight lately. Wells Fargo upgrading shares to equal weight from underweight, also upped its price target to $100 a share, up from $52 a share. And analyst Steve Cahall wrote in that upgrade note, quote, WWE's strategic process has a reasonable probability of success. And a lot of that has to do with potential buyers. Some of those names include Netflix, Amazon, Comcast, Disney. They could all want a piece of this at the end of the day. And of course, we heard from a source that told Yahoo Finance last week that WWE has not been sold to Saudi Arabia's public investment fund. That was a big rumor that sent shares higher. But again, all still a possibility. And Wells Fargo did estimate that WWE could be worth about $8 billion in a sale. Its current market cap is around $6.6 billion. So we'll have to wait and see what happens with this stock.
We will. The stock closing up just about 0.3%. Right. Thanks so much, Ali. We're going to get to some breaking news. United earnings are out. We're seeing that stock pop after hours. Jared Blickery has that for us. Hey, Jared.
That's right, and it's spilling over into the other airlines as well. American Airlines, Alaska, and Southwest also up, as you can see. But United in the upper left, you can see it's up about 5% there in after-hours trading. Let me get you the numbers. Fourth quarter results. Adjusted EPS coming at $2.46 per share. That was a loss per share. $1.60 was a year ago number, and the estimate was for $2.12. Now, operating revenue of $12.4 billion. That bested the street estimate of $12.23 billion. Also up 51% year over year. Breaking that down, passenger revenue $11.2 billion. That was a beat, up 63%. Cargo revenue was a miss, $472 million. That was down 35% over a year ago. The key metric of revenue per average seat mile, that is 17.42 cents. That is slightly higher than the estimate of 17.13 cents, and that is up 39% year over year. Revenue passenger miles, that was 54.76 billion, up 30%. The estimate was for lower, 54.39 billion, small beat there. And then average price per fuel gallon, $3.54. Estimate was for $3.59. So looking decent on the airline front today with these earnings.
All right, thanks so much, Jared. Well, we will dive deeper into these numbers right after the break. Again, the stock moving higher after hours.
United shares moving up 4.5% after reporting outstanding Q4 earnings. Joining us now with more on this is Peter McNally, Third Bridge Global Sector Lead for Industrials, Materials, and Energy. Good to see you, sir. What's your first read of the earnings?
Well, I think we understood that demand has been very strong for air travel. American and Delta clued us in on that. But I think what jumped out to me in these results was the guidance for 2023. It looks like $10 to $12 in EPS versus the street about $6.50. So that's like attention grabbing. And just for a reference point, back in 2019, the company made a little north of $12 per share. So they're almost all the way back in terms of profitability on a per share basis. The other thing that we've been watching with United is their aggressive investment program. And it looks like CapEx of $8.5 billion is going to be more than what American and Delta have slated combined. The United's ordering a lot of planes, and I think you can see that in the way Boeing's stock price has been behaving, and a lot of the headlines that United has made ordering 787s and 737s. Yeah. So there's a lot to digest, and just looking at the first part of it looks pretty upbeat, though.
Yeah, I wanted to ask you about that number there, the CapEx number, $8.5 billion, when the estimate was for $8.25 billion, so more than even the street was expecting when it comes to United. Is it too much? Does that give you, I guess, a pause at all, just in terms of what we could then expect from United over the next 9 months?
Well, this actually started right in the middle of 2021. I mean, it wasn't clear how long it was going to take us to get out of the pandemic, but that's when United had its largest order in the company's history, for Boeing and even some Airbus planes, and they have continued aggressively investing ever since, betting that the market is going to come back and exceed pre-pandemic levels. So, in order to attract pilots, you need new planes, and it's been proven that customers like the newer planes as well. They're more efficient, and United really is investing for the future. While the $8.5 billion number is bigger than what the street is looking for, it does fit the pattern with what United's been doing the last couple of years.
All the airlines really seeing the headwinds that are pilot shortage and supply chains in terms of getting new aircraft. How is United impacted?
Well, the most interesting thing for United will be their upcoming pilot negotiation. I think Delta put a marker out there by offering a 30% increase over the next 4 years to their pilots. But United's got some work ahead of them on negotiating with their own. And, we've been learning over the last 2 years that this is a labor intensive and labor critical, industry. It's their biggest cost. And these planes aren't getting off the ground without pilots. So watch that.
Peter, how would you say United stacks up to some of its competitors? We just heard from Delta last week. American just raised its guidance in terms of what we could expect here in the fourth quarter. Are they in a better position than some of its peers?
Well, if you believe that this market is going to exceed prior highs, United is most aggressively betting on that happening. It's you see it in their aircraft orders. They've got the balance sheet to do it. Delta's going into the pandemic was better, I think, on most metrics. But United really is betting on its future. And it's not just in like basic aircraft traveling point A to point B. They've also been throwing money at a lot of technology as well. So things like supersonic, air taxis, sustainable aviation fuel. These are somewhat smaller investments that may pay out, in the long run. But United's betting on its future for sure.
Of course, the big airline story of, quite frankly, the last several months, if not the year, has been the meltdown at Southwest Airlines. How long before they dig out of all that mess?
Well, this is, at least according to the Third Bridge experts, this has been building for quite some time. And Southwest, has not invested enough. And I think that was manifest itself over the holidays, but they're facing a lot of competitive threats, both from above and below. It's not the low cost carrier that it once was. They're even lower cost. These ultra low cost airlines like Spirit and Frontier have been a real competitive threat to them. And at the same time, they've grown so big that they're finding themselves in direct competition with the majors like United, Delta, and American. So Southwest got a lot of work to do. They've always been more revenue focused, our experts would say, rather than operational focused in the last few years. So, we'll see, but it's going to be quite some time before these things get hammered out.
We will see. All right, Peter McNally, great to have you. Thanks so much. Well, the White House doubling down on its refusal to negotiate with House Republicans over the debt ceiling. Here's White House Press Secretary Karine Jean-Pierre earlier today.
As President Biden has made clear, Congress must deal with the debt limit and must do so without conditions. But congressional Republicans are threatening to hold the nation's full faith and credit, a mandate of the Constitution, hostage to their demands to cut Social Security, to cut Medicare, and to cut Medicaid.
Yahoo Finance's Rick Newman is here to tell us 3 things to keep in mind about this potential standoff. Rick, it's great to see you. So first, you're saying this is nothing but a political stunt.
We've seen this so many times before, and what Republicans do every single time is they withhold votes to extend the federal borrowing limit as leverage for other political demands they have. And, they're not going to look, Democrats control the Senate, so Republicans are not going to pass any legislation that includes big Democratic priorities. And the big thing they want to cut there that the White House press secretary mentioned really is Medicaid, the health program for the needy. They're not going to get Democrats to agree to that. So what they're going to do is try to use this as a messaging tool so that voters can find out, oh, they really, really want to cut spending. If they really cared that much about the federal deficit and the huge national debt, they would not do things like underfund the IRS for a decade and try to roll back the new funding for the IRS. What the IRS is going to do is collect tax money that people legally owe, which will help narrow the deficit. There are other types of things they would do. Cut defense spending. You're not going to hear them say a word about defense spending. That's one of the biggest categories in the federal budget. So look, all this tells you Republicans are not really serious about fixing deficits or bringing down the national debt. This is just a messaging and a political exercise for them.
You are hearing a bit, though, about some defense cuts, at least from certain portions of the Republican Party. And we saw how much power that small wing of the party has as that debacle in leadership played out. So you say eventually this just gets done when?
It's going to get done at the last minute, and we don't quite know when the last minute is going to be yet. Now, Janet Yellen, the Treasury Secretary, said this coming Thursday is the day when the Treasury will hit the limit. It will no longer be able to borrow to finance the bills that it has to pay. But then there are a lot of things the Treasury can do, basically moving money from one account to another that will buy time. So that could give 3 or 4 months until the Treasury really can't pay all the bills, which might be, analysts at this point are estimating early June. This is really going to become crunch time as we get closer to that date, known as the X date. And that's when markets are going to start to notice. So the Congress has always raised the debt limit before, but it has been very ugly a couple times in the past with some actual harm done. So that's what, markets are actually getting nervous about already.
And Rick, speaking of that harm that has been done in the past, what do you think the real damage could potentially look like from this?
2011 is the baseline for the sort of the worst way this could go. So what happened in 2011, very, very briefly, a big standoff, similar to what we're going to see during the next few months. Congress did not resolve the debt limit extension until literally hours. Down to within 1 day of when the Treasury Department would be unable to pay bills. And that actually had a pretty serious effect on the stock market at the time. And that's when Standard & Poor's, for the first time ever, downgraded the U.S. credit rating by a notch, and it is still at that lower level today. So just as a baseline, stocks fell by 17% in a month around that showdown, even though Congress did ultimately end up raising the borrowing limit. And it took the stock market, the S&P 500, about 6 months to regain those losses. So this is not just verbiage. This really can affect markets if it gets pretty close. And many analysts are saying they think that is what's going to happen this year.
Exercise in futility. Congress at its finest, Rick. Good stuff.
You got it, man.
All right. Coming up,
Bye,
one
guys.
of the biggest issues facing the housing market right now, high mortgage rates. Our next guest tells us how to invest in real estate and what buyers need to know. That's next. In a word, the year in real estate saw wealth destruction, given the rapid rise of interest rates. But 2023 should bring falling rates, and that destruction replaced by disruption. Let's talk real estate with Hines Global Chief Investment Officer David Steinbach. He's with us now. Good to see you, sir. So you say disruption brings real estate opportunities. Play that out for us, and where exist those primary opportunities?
Great. Well, look, thanks for having me. So Hines is a $100 billion global investment manager. We focus on real estate. We're in about 30 countries around the world. I'm actually calling from you here in Davos today. So I would say that disruption is definitely a topic here as well. I think that investors right now are really seeing the change that's already happened, right? Interest rates kind of riding this wave of low interest rates, and the cap rate compression that comes with that is over, and now the hard work of asset management really begins, and that's really what's in front of most investors today. I think though the general mood that I'm feeling here in Davos though is that I think that people are pretty somber about the realities of the market, and really starting to focus much more on the beginning of a new cycle rather than the end of an old one.
Sure. And rates that, should we believe, begin to fall, are they optimistic about investment opportunities in real estate as we move forward?
Yeah, so I think that the way to think about the built environment is certainly one is that for an institutional investor, real estate is a longer term investment that we're making. So it's not something that we're flipping in and out of like equities or bond. And most business plans are lasting 5 to 10 years. And so in light of that, I mean, interest rates are certainly a driver of value, and they've had their impact this last year. I think that obviously if rates continue to move in this coming year, that'll also be a driver. But I think what I'm saying though, the focus is really on how to create the value at the real estate itself, how to drive rents, how to create something that is special and unique, something that is going to outperform within the context of a particular market. But where the rates are today, again, it does affect value. But I think most real estate investors are thinking longer term when they're underwriting a deal today.
Give me a sector and a region in terms of housing that you are optimistic about as we move forward.
Sure. Yeah. So Hines is involved in really all the major product types. We're in multifamily, we're in office, we're in logistics, retail. And certainly in the housing sector, I think particularly in apartments, which is what we focus on with our institutional and retail clients, it's really what is interesting about that asset class is the fact that rents mark to market every year. And that is different than the other major product types where investors are relying on a bit longer term leases. And the fact that mark to market every year means two things. One is you are going to see, as fundamentals have come down in many markets, particularly here in the United States, you will see returns come down as well. With that said, on the other side of recovery, it'll be the first to come back up because again, you're marking to market at a much faster pace than the other product types. So look, broadly, I do think that demand around multifamily, while it has slowed, I do think that given this dynamic in the lease term, that it will be one of the first things that investors will be focused on the other side. And look, fundamentals in the United States, they are declining. So you have to focus on the fundamental real estate you're buying. And again, think longer term. I mean, you're buying something today, you're going to own it for 5 to 10 years. You want to make sure what you are going to buy today is something that will perform in that time frame.
Let's turn to office now, and one of the big question marks that lies ahead. Are you bullish or bearish, and what's been the impact of remote work, and do we know the true impact just yet?
Sure. So the way we are obviously investing is around the world, and I think this return from work question is a really interesting one because when you zoom out and look at the world in total and look at how everyone has responded post-COVID, every country is not in the same place in terms of how much remote work that they're relying on. So Asia, for example, would be one end of the spectrum, and frankly, the West Coast of the United States would be the other end. And basically all the geographies are somewhere in between there, with Europe being somewhere in between as well. And so what that tells me is two things. One is it says that whatever you might be experiencing today in your market that you're seeing every day is not necessarily the felt experience of those around the world. So as an investor, you have to think globally in that perspective. But the second thing is that what we're seeing is that there is a steady trend back. I mean, the chart is up and to the right. And even markets that like in Asia where it was nowhere near like what it was in the West Coast of the United States, for example, even that is on the right road, if you will. With that said, what we're seeing as well is that, particularly here in the United States, it statistically seems to us that 90% of the tenants are chasing about 10% of the space. And so if you own projects today in that 10%, what we're seeing in our portfolio is they're actually performing really well. I mean, we're seeing rents within that narrow band, which is the highest quality, obviously, some of the highest rents that we've done. We've got projects in New York. And it is surprising when you see the headlines and see the data. But what's interesting though is despite that dynamic, the 90 chasing the 10, capital markets seem to be painting a much broader brush across the product type, and really not seeing through that yet. I think that'll be another thing that we're going to see evolve in the next coming quarters, where investors are going to be looking a bit more carefully at what exactly is happening in fundamentals and look at the data as they do their due diligence. I think that they'll take a turning view.
All right, check back with us in a few months. David Steinbach, Hines Global, joining us from Davos. Appreciate it, sir. Coming up, can Washington block TikTok? A look at how the influencer economy might react, coming up after the break.
Rumblings of a possible TikTok ban grow with University of Texas at Austin, the latest to block access to the social media platform. But the influencers that make a living off TikTok, they aren't too worried about their future for now. Here with more Yahoo Finance's Ali Garfinkel. Hey, Ali, what can you tell us about what the influencers are saying about this possible ban?
Hi, Shauna. So it's important to start by defining our terms. An influencer on TikTok, if you're thinking about it, you might think of Addison Rae or the D'Amelio family or maybe even The Rock. But in reality, there's a world of influencers with millions of followers in many cases, and this is their job. They work in marketing, they work in fitness, and I spoke to some of them to see how these waves of state bans and the fiery talk coming out of Congress, frankly, make them feel. And the message I got was that though this is a looming concern, there's a ways to go before we're worried. Now, why? I would say there are three key things. The first is that, for one, Trump did fail to ban TikTok in 2020, and I think that's provided some consolation. That's something I heard over and over. Two, their businesses haven't been affected yet. Again, everyone I spoke to said, yes, we've been hearing all about these bans, but my business is the same as it always has been, if not better. And the third is, honestly, on Washington. Washington has been so vague about what's possible and what might happen on a federal level that there is, again, concern without panic is the thing I kept hearing. I actually spoke to Chase Chappell, who has more than 200,000 followers on TikTok, and I liked the way he summed it up, and I'd love to read what he said to you. My only concerns are around potential what-ifs, but I can't worry about what-ifs all the time. Otherwise, I'd be worrying, and that's not good for anyone. I liked the simplicity of that.
All right, Ali, great stuff. Thanks so much for bringing us the latest on that. Well, maternity brand Hatch, made famous by celebrities like Meghan Markle, Amy Schumer, Kate Upton. The brand now raising equity in a round led by marquee brands that will lead to a newly created parent company, bringing a number of maternity brands under just one umbrella. Joining us now is Ariane Goldman, the founder and CEO of Hatch, also the CEO of the newly created Hatch Collective. Ariane, it's great to see you here. So a number of brands now under one umbrella. So it would be Hatch, Motherhood Maternity, P in the Pod, Destination Maternity. You are leading the charge on this. So just talk to us just about why the move and why it makes sense here for your business.
Absolutely. I created Hatch almost a decade ago to really provide women with solutions during this next journey in their life, providing them a voice, a brand, community, content, and really someone listening to them. And in the last 6 months, looking for a capital partner, Marquee Brands and I started to dance a little bit and talk about the potential synergy between their portfolio of motherhood brands, which have huge brand equity, heritage, and really what we were doing in the maternity space is the gold standard from a brand level, and how together we could be more of a powerful player. So it's an incredible opportunity right now to be at the helm of this strategy and architecture, really consolidating my competition under one purview.
Yeah, speaking of becoming a more powerful player, because I know your revenue was up 70% in 2021, up 30% in 2022. This united platform, how much growth are you expecting from a revenue perspective? And I guess why is it so advantageous?
I mean, the market right now is pretty quiet, and so I'm really excited to be well-funded, capitalized. Hatch will triple our growth this year profitably, which is really exciting. We can get leverage across operations, distribution, really make wonderful negotiations with financial institutions. So we can step on the gas when the world around us is a little bit quiet. And now we're going to be poised. 2023 is really going to be spent on synergizing, prioritizing, understanding the business, architecting the lanes between the brands. But moving forward in 24, we're going to be poised for explosive growth.
Ariane, what are you seeing just from a consumer perspective? Because we talk time and time again here on the show, on the network throughout the day, that we're seeing the consumer begin to pull back in spending or adjust how they are spending. Are you seeing an impact on your brand so far?
You know, the beauty about maternity is that it's a need-based niche business. It's not fashion. It's not something that you just choose to want. It's something you need as you go through this chapter as a woman. And so providing women's solutions at both price points now, both aspirational at Hatch and value-driven at the motherhood level, is going to be a huge win for us, because people, when they need a nursing bra, when they need something, when their jeans bust, they're looking to buy something that makes them feel better during this time, and we're going to have it for them.
I've been in that position a couple of times before, and Hatch has really helped me get through some of the, especially the last 6 months, which can be pretty challenging trying to find clothes that fit and look flattering at the same time. Ariane, last time we spoke, you recently announced the collaboration, the partnership with Target, and within that you launched a brand called By the Nines, I believe. Talk to us just about the success of the Nine so far with Target and whether or not you have similar partnerships in the pipeline.
Yeah, so the Nines with Target, the Nines by Hatch for Target was an exclusive line that they came to us to design, really taking the Hatch philosophy of beautiful dressing and applying it for a better price point for more women. It was a 2-year relationship that was beautifully successful, but knowing that motherhood and P were kind of in our destiny, we've since sunsetted that relationship and that brand so that we can really focus on the mass market play with motherhood maternity. I'm really excited to be able to design and own this category across both lanes, different households, different price points, but really putting the why behind the product and a female-founded, driven, and really strong leadership team behind all these brands.
I'm curious to get your thoughts because I feel like, especially over the last couple of years, the whole conversation around maternity, around pregnant women, something that people tried to steer clear of in the past, has really gone mainstream. People aren't ashamed to talk about it anymore. What do you attribute this to? And I guess how much of it do you think social media plays a role in that?
A huge part. It's been, since I started the company, back in the day, women were scared to tell their bosses that they were pregnant. They were nervous about the repercussions of being pregnant in the workforce. And with the rise of social media, editors getting pregnant, selfies, the idea that you can really just show the strength of your bump and be empowered as a woman the last couple of years with the female movement, it's all empowered women to celebrate the fact that we can both work, we can be moms, we can do so many things, which has changed the landscape completely, which is amazing because now women feel comfortable investing themselves. And, fortunately, Hatch has been there the whole time. And now with motherhood, we can provide product that just makes women feel great.
And so important. Ariane Goldman, great to have you, CEO of Hatch Collective. All right, well, coming up, our coverage of the World Economic Forum continues. Barnard College President Sian Bilak joins Yahoo Finance to discuss America's higher education crisis. That's next.
All right, our coverage of the Davos World Economic Forum continues, where earlier our very own Julie Hyman sat down with Barnard College President Sian Bilak about the state of higher education here in America. Bilak will soon be the president of Dartmouth, where undergraduate students are fortunate enough to avoid student debt thanks to grants provided by the university. Let's hear what she had to say.
Dartmouth is really amazing in its ability to be need blind and meet full financial need, not just for domestic students, but for international students. And it is a really attractive proposition to be able to look and find the best and brightest, regardless of background, and bring them to a place like Dartmouth to learn and grow and hopefully go out and change the world.
Obviously, every university can't do that, right? And every college and institute of higher learning, because they don't necessarily have the financial resources. What do you think needs to be done on a broader basis about the student lending situation?
I think there's no one size fits all for how education works. I think that's really important. And I think we have to think about all different sorts of degrees and success at all different sorts of degrees, whether it's certificates, 2-year colleges, and actually helping students get to 4-year universities if that's what they want. But it's time to sort of unpack and look at different ways to have individuals get the skills they need to go out and be successful in our workforce.
Do you think that's something that needs to come from the top down, from the government changing the sort of lending system in the U.S.? Do you think it needs to come from universities? Do you think it just needs to be a cultural change with how we approach higher ed?
I do think universities and institutions have to have some responsibility for an ROI on the student investment, and I think not enough institutions are really talking about that, putting it forward. It also, I think, comes from companies and students demanding those sorts of changes. But when you're talking about what you might learn at an institution, that institution should also be talking about the percent of students that go on to get jobs, go to grad school within 6 months, what you would make, the skills you would learn. And it's time to connect higher education with the skills we need in the workforce.
Of course, it's not just about this sort of nitty-gritty learning for an education, right? And the magic of Davos, we happened to be at a dinner last night where you talked about some of these themes. What is the biggest problem or biggest challenge or biggest gap that you see among students right now when it comes to just, are they going to class as much as they should be? Are they paying attention in class? Are they, what is the biggest issue right now?
Yeah, I mean, there's no question there's a mental health crisis among young people. And again, I think this is where institutions and companies, when they employ those individuals, really have a part to play in this. How we support students, how we think about ensuring that mental health is part of what success is, and actually being very explicit about what it means to be successful. Many young people spent 3 years interacting with everyone through devices, through the screen. We know the value of in-person contact. We know the value of those informal conversations. We now have to make that explicit for the younger generations so that they're poised to take the great next steps.
How is all that manifesting itself, the mental health crisis that you talk about on campus?
Well, we're certainly seeing it in increased feelings of loneliness, of depression, of anxiety, and this is where institutions can come in and really play a part. At Barnard, where I'm president currently, we're actually building the Lafrac Center for Wellbeing in the middle of campus that's focused on physical well-being, mental well-being, and financial well-being, because we believe that especially for women to be empowered and be mentally healthy, you have to be financially healthy, and this is all part and parcel with what success is.
I'm curious, once those students then leave and go into the workforce, what do you want them to say? You're a cognitive scientist, I should mention as well, and so you investigate all of these issues. What do you want them to take away? I mean, obviously, employees need support from their employer, from their community, et cetera. But internally, what do you want your students to take away in terms of how they can preserve and foster their mental health?
First of all, I want them to take away that failure is part of life and that it's not always about being safe. Like, being uncomfortable is part of growing. And so I want them to take away this idea we talk about as a brave space, that it's okay to fail and get up, and those are some of the best challenges that you encounter. I want them also to take away that you don't do this on your own, that there are times when you reach out to people who are experts. As a leader, I reach out to experts all the time in different fields to understand and to take step forward. There's places to go if you need mental support. These are all things, we're not in this alone. And I think that's the onus is on companies now to think about how they support their workforce, and certainly on institutions. We're not in this alone, and successful people rarely do it alone. And by providing some of these supports at the university level, I think we poise students and put students in a place that when they go and take that next step, they also know they don't have to do it alone.
And just a quick follow-up question on that. There has been this wave of more corporations providing mental health support. Is it real support? Is it helpful support?
Look, I think even acknowledging that our mental health matters is so important. We know as psychologists, calling things out for where they are. I think it's such an important component of having a sticky workforce, of individuals thinking that their company cares about them, that they belong. This is good business practice. If we want the best outcomes out of people, we have to help support them so they can do their best thinking. And so there's a variety of ways to do this, but even providing free counseling or providing, places where you can take a mental health day or other things. These are the kinds of supports that I do think they have to be systematic and they have to be company-wide, but can actually change how people feel about an organization.
Sian, thank you so much. Sian Bilak, Barnard, and soon to be of Dartmouth as well. Appreciate it.
All right, thanks, Jules. And a wonderful message there about the importance of mental health in the workplace. Let's move now to Shauna. What's moving after hours, my friend?
Hey, there's three movers here after hours. We have United, we have Interactive Brokers, and Moderna. Let's kick it off with United. You're looking at gains of just about 3% here in after hours trading. We're up more than 6% earlier here in the afternoon trading. Positive results here from the company. Q1 profit, a lot of focus there. The outlook from United topping the street's estimates, actually more than double what the street was looking for. For the fourth quarter, the numbers were pretty strong. Adjusted EPS of $2.46, revenue of $12.4 billion. Putting that in perspective, that's up more than 50% on a year-over-year basis. Passenger revenue was $11.2 billion. That's up more than 60% on a year-over-year basis. Over the past 3 months, we're looking at gains of just about 41%. Over the past year, we are still in the green, up just about 9%. Let's take a look at Moderna. That stock popping here after hours, up nearly 7%. The move higher coming on positive results for its RSV vaccine. Phase 3 study of mRNA 1345. The company saying that it targets RSV in older adults. It met the endpoints of this study, saying that it was well tolerated. No safety concerns have been identified so far. Plans to submit for regulatory approval in the first half of this year. That stock up just about 6.6% in extended trading over the last year. We're still looking at losses from Moderna after the stock shot up in the height of COVID, but that stock off just about 7% over the past year. And taking a look at Interactive Brokers, that stock moving to the upside, up just about 3% in extended trading. EPS and revenue both beating the street's expectations. EPS of $1.30, adjusted net revenue of $958 million. That's up 40% from just a year ago. Total customer accounts just over 2 million, 2.09 million. That's up 25% on a year-over-year basis. Over the past 3 months, we're looking at gains of just about 12%. Over the last 6 months, the stock well in the green, up just about 40%. But again, Interactive Brokers moving to the upside in extended trading, up just about 3%. All right, well, coming up, Match's dating app Hinge is testing out a new subscription tier for Gen Z daters. We'll tell you how much the company is looking to charge when we come back. Getting a date these days, well, it could cost you a pretty penny. We're not just talking about the actual date. Now, Match Group's popular dating app Hinge testing out a plan that could cost up to $60 a month for who they call, quote, motivated daters. This would be a new premium level that's a step up from their current $35 a month paid tier. Now, for that price, users will get more exposure. Their like will be seen faster by other users, and they'll also be getting better recommendations for users that Hinge thinks that subscriber will be most interested in. Dave, this is interesting
you see
to
my
me
skepticism?
because I'm very skeptical about this $60 a month. That's a ton of money, especially in this economy. And it doesn't sound like, at least from what we just read, that you're getting a heck of a lot of perks with it.
The price of eggs is up 60%
You
year
can't
over
afford
year.
$60 a month on Hinge,
No.
not knowing, guaranteed that you're going to find love.
Up from 35, and what blows my mind here is they have this readily available. They could make it faster now. They could provide you better matches now. They choose not to when you read the fine print here, but you can get it for 15 more bucks a month. Is dating online and recession proof? I don't think so. I think given inflation, people are going to run away from that type of price tag, but I'm old. I don't even know what it's like to online date. I, though, was blown away when I read about Match's other dating app, Tinder, testing a user interest in a version that would cost $500 a month. They're allowing people to join a wait list if the version becomes available. What does that do? Actually pay for dinner? Because
I would hope
anything
so.
short of that is outrageous, and I can't imagine anyone with that type of disposable income is on Twitter and Tinder in the first place.
Yeah, I feel like if you're charging $500 a month for a dating app service, you need to have somewhere in that clause that it's guaranteed to find you the love of your life or someone that you are going to date.
They're going to buy the bottle of wine.
Because you deserve something if you spend $500 a month. I don't know who could afford that. That is something that's not even on my radar. I don't even know if I would pay $5 a month, but I am happily married, so maybe I'm not the best person to be asking that, but I just think the explosion of dating apps is something that has just been crazy to witness over the last 10 or 15 years, the popularity of it, so many success stories, some success stories for people on our staff, so they work. I just don't know how much
Match
demand
Group
there's going to be for
down
that
about
thing.
70% last year, one of the biggest losers in the market. They are up 15% though year to date, so perhaps some investor optimism, if nothing else.
And that also explains why they're trying to charge people $60 a month for Hinge and maybe $500 a month for Tinder.
I'm
Maybe
swiping
Twitter
left
might
on
also-
that. Is that how you say no?
Yeah, left is no,
I'm
right
saying
is
no.
right. All right,
Swiping left.
I'm swiping left too. All right, well, that'll do it for us today on Yahoo Finance Live. Be sure to come right back here, 3 p.m. Eastern Time tomorrow. We'll see you then.